Well, hello, and welcome to our second panel discussion. Does COVID change ESG or reinforce it? We're meeting at an extraordinary time for environmental, social, and governance investing and the whole responsible investing movement. The adoption of ESG has really been increasing exponentially in the last few years, and that is apparent from however you try to measure it, whether using statistics or just the general prevalence of talk about sustainability and issues like that in financial circles. And in the last 2 years, it really a new current has come in, I think, a new awareness that we need to think not only about environmental, social, and governance issues as drivers of risk and return in a portfolio, but also start to think about the impacts the way we invest are having on the outside world. And this is really, in a way, a throwback, arguably, to the ethical roots of the whole responsible investing movement. This growth, I think, has been driven by climate change and by the incredible surge of consciousness about that. But of course, now in 2020, we're faced with a completely new situation, which is arguably an environmental or a social issue, the global COVID-19 pandemic. And that, of course, is changing the whole context for all these discussions and all this thinking. So I'm very glad to have with me today a superbly qualified panel of experts and from very different perspectives. I'm going to ask them to introduce themselves now, just saying who they are and what their involvement in this field is, starting with Clara.
Thank you so much, John. Briefly, my background is as a partner at one of the pioneering early sustainable investment fund management firms called Bridges Fund Management. But I have been on secondment for some time now and will continue to be to a project that was set up to facilitate standard setting about social and environmental performance. And the connection I just want to make between that and your opening remarks is that much of my work is spent bringing different types of standard setters together to look at how companies' impact on the world then in turn create dependencies, both for management teams, but ultimately for providers of financial capital. I'm delighted to be with you here today.
Thank you. David.
Hi, John, and thank you very much for the invitation to join you today. I'm head of sustainable business at London Stock Exchange Group. I work across the group on how we integrate sustainability into our products and services and how we support the marketplace. So that's everything from London Stock Exchange and Borsa Italiana, also through to FTSE Russell and the index capabilities. So, which is also where I joined the business many years ago, having worked on a range of ESG and climate indexes. I also work on the kind of policy side as well, with interacting with policymakers and regulators. I was also a member of the high-level expert group on sustainable finance, which the EU had set up before the Sustainable Finance Action Plan.
Thanks, David. My-Linh.
Great, thanks very much, John. So my name's My-Linh. I work at BlueBay Asset Management, and my role is essentially to ensure that we sufficiently incorporate ESG considerations into our investment practices. My background is sort of all on the buy side, looking at sort of ESG in the equity context, and then laterally and presently in the fixed income context.
Thanks. Heike?
Hi, thanks very much. So I'm very happy to be here. I'll bring the perspective of a fixed income issuer to the panel discussion. I'm at the World Bank and the World Bank Treasury, and we're responsible for the issuance program of several issuers, the largest, of course, the World Bank, with $55 to $65 billion a year. Then another issuer, IDA, International Development Association, that recently accessed the capital markets, and we expect IDA to have a program about $10 billion over the next 10 months, $10 billion. And then we're also responsible for the issuance for IFIM, the International Finance Facility for Immunization. So those are all fixed income issuers, and they all have a social mandate. I've been working on sort of building sustainable capital markets for many years, and I'm looking forward to the discussion.
Thanks, Heike. Andrew.
Good afternoon, John. My name is Andrew Steele. I run Fitch's global sustainable finance business. We're a credit rating agency, so our comments generally revolve around credit aspects and focus on those in particular. And so we may have some slightly divergent views from some of the other panel members in that respect. In Fitch, we've been working at integrating ESG into our credit ratings analysis and transparently displaying how environmental, social and governance risks impact those ratings. And then we've been also looking at other ways in which we can provide insight and opinions on ESG and credit risk to investors and other market participants.
Thanks, Andrew. Faith?
Hi, so I'm Faith Ward. I'm the Chief Responsible Investment Officer at Brunel Pension Partnership, which is one of the asset pools for the local government pension scheme in the UK. We have about 30 billion of assets in aggregate, so we consider ourselves to be an asset owner. And our asset classes span everything. So passive, active, listed equity, multi-asset credit, fixed income, and a whole diversity of private markets as well. So we'll bring the aspects and challenges that come from trying to integrate environmental social governance issues across the whole plethora of issues. And Brunel is very strongly committed to being a responsible investor in embedding environmental social and governance issues into every single one of its portfolios, but obviously recognising the fact that that approach has to fit with the investment style and the asset class for which it's designed. So that does create some interesting dynamics. I'm sure we'll get into some of that later.
Thank you, Faith. So before we start, I'll just mention that to anyone watching, you have the opportunity to ask questions to this panel of experts. It's a rare opportunity, and please take advantage of it. In your hub screens, there's a little chat function below the screen where you see the video. You'll have to come out of full screen view to see that, but please feel free to type in questions there, and we, the panel, will try and answer them at the end of the session. Thank you. So just to begin, I'm going to turn to My-Linh first, but we're going to tackle a big question to begin with, and this is whether the COVID-19 pandemic confirms that ESG investors were right all along. Does it show that basically people arguing all this time that environmental and social issues mattered were right, or is it a challenge for the ESG community and really a surprise that we need to digest and work out how to change to respond to?
Yeah, thanks very much, John. I mean, it's a big question. I think, like you said, I think my response is that yes, it confirms ESG investors were right all along. And I guess it depends on how you define ESG investors, but I guess I would include in that sort of all investors that have a more holistic view when they're looking at their investments and considering risks and opportunities and returns and impacts, that sort of thing. But I guess how I'd frame that right is that I think for a while we've been sort of making the comment that these sort of issues, non-financial, extra financial, whatever you want to call them, really matter to financial markets, and they're increasingly relevant. They've always been around, but I think what we've seen is with the scale and the growing environmental social challenges we're having is that they're increasingly relevant to markets, such that a few of them have been elevated to be sort of considered systemic financial risks in that way. And I think it's sort of obviously, who could have imagined that it's taken a virus, in this sort of context to actually bring the world to a standstill? But it's highlighted how I think ESG is really encouraged in terms of making you recognize that everything is interconnected and everything is interdependent. So I think that's where I would bring in how you think about ESG investors, is that we're trying to bring another perspective, and it's a more holistic view of considering risks, returns, and impacts. It's asking people to think more long term. It's asking people to be broader in their consideration of what performance matters on that side. So I think that's where it's important in that way. And I think it's also a great window into what could happen with climate change. I think a lot of people have drawn that parallel and sort of said, well, actually, we've seen it condensed in a very short space of time, but actually, this is the scale of transformation and impact we're going to get with climate change if we don't do anything about it. So I think it's, in a way, hopefully people take this as the wake-up call that it is, and then see that we should do something. for me, maybe moving a bit away, that I'm actually been quite heartened in that I think if we look at this crisis and think about it, is that we should actually be positive in a way as well, and that is realized actually what action we can take in such a short space of time if we really want to and we know it's important. So I think if there's the political will, the speed and scale of what we can do. So I think that's where, for me, all the naysayers about climate change, we can't do this, we can't do that, it takes too long, it's too complicated. Look what's been possible in the last few months. So I think that's where I'd be sort of heartened by that. But it's also, I think, highlighted another aspect of ESG thinking, is that you need this, coming back to this interconnectedness and dependency, is that we need a coherent and a cohesive approach to this, because we're seeing some splintering now with different approaches to COVID, which could undermine its effectiveness. But yes, overall, my answer would be that because of the way investors who incorporate ESG think in terms of their timeframes, the parameters and lens that they look at, I would say it does affirm that what we've been saying is something that has value.
Thank you. Faith, you're obviously a responsible investment practitioner. Has the pandemic made you think, I've got to change what I do?
Actually, no, and a lot of it sort of falls nicely after what My-Linh was saying there. I think that a lot of the themes and ideas that we had before the crisis, we were actually doing quite a lot of sort of forward strategy thinking actually in February. And actually, the themes and ideas that we had remain the same. What the crisis did was elevate certain themes within that. So, and I think we'll probably dig into some of these, the E, S and G. However, in terms of their sort of coverage and data and the things behind those aren't equal. Governance dominated at the sort of very early part of the responsible investment journey, and then environmental issues have come to the fore. This is the time when social issues have really rocketed up the agenda, and people recognizing the value of human capital and the human element of supply chains and dependencies and some other aspects there. So I think it's sort of amplified, if you like, a lot of the issues, and certainly made me quite challenged as to how we spread our time, because there's still just so many important things, but it feels like there's even more to do and more urgent, and it's certainly a window to amplify some issues. And as My-Linh said, I think particularly on the climate change issue, we've seen in order for the climate emissions to come down, which they have obviously done dramatically when we went into lockdown, what the economic impact is, how interdependent our current economy is from a climate perspective, and what the kind of economic shift would actually need to happen to actually reduce those emissions down to those levels. And similarly to My-Ling's point about kind of the I think some corporates have ridden, going with a lot of their response to some of the climate, agenda has been policymakers. They won't, they don't have the nerve. They'll never take these steps. It's just the economic damage is too huge. You still think that now? You think in the face of a crisis, they won't take the most dramatic action necessary in order to address that? And I am hoping that has recalibrated the thinking of many large, maybe oil and gas majors, particularly in the US, who have taken quite a approach that things will not change. Business as usual is the way it's going to be, and I think that hopefully that has been called into question.
That's very interesting, and I'd like to ask Andrew. You obviously at Fitch, you've got a systematic process for thinking about ESG, and have you had to recalibrate that?
The short answer to that is no, we haven't. It is an approach that focuses very specifically on downside protection and the credit implications of environmental, social and governance risk factors on a sector by sector basis to the ratings of entities. And it's interesting because I think in that perspective, we maybe have a slightly different view, not misaligned with My-Linh or Faith, but I think what we see that there are a lot of aspects that have occurred so far which we think are yet to play out in terms of what the true implications are from an ESG perspective. And the reason for that is at the moment we've seen a lot of short-term supply and demand disruption from COVID-19 and a lot of action that has been government directed. And similar to what Faith was saying, I think there are a number of long-term ongoing issues that have been exacerbated But quite interesting, most of the pressures that have damaged financial profiles have been surrounding liquidity so far, rather than permanent behaviours, changes in consumer behaviour, for instance. And so we think that there's a longer term play out of the consequences of this as the government direction starts to ease off and we start to see the true impact in terms of which areas get accelerated. I mean, if you look across our ratings, we've taken 4,000 rating actions, the majority of which have been negative, and there have been very, very few which were due specifically to ESG factors, and where they were generally existing factors that have been identified that were being exacerbated by either, governance issues emerging in an entity, actually predominantly governance issues emerging in an entity. So I don't disagree, but I think we're a little ways off deciding yet what the sort of longer term implication is going to be from a credit perspective in terms of acceleration or a return to, as Faith was saying, will some of these entities change their actions, or will they slowly return to where they were before, at which point the momentum for policy change and the requirement for policy change that she also mentioned starts to become quite a very pressurized build up in the background, I think.
But you're almost saying that you've done 4,000 rating actions because of COVID, but only a few of them were ESG caused by ESG, so COVID isn't really an ESG issue.
Yeah, I mean, a lot of this depends on how you look at COVID and whether you consider, COVID as a whole to be a social factor. If you do, then you kind of end up with a little bit of a blunt tool if you're not careful. And the way in which we construct our system is very, very specific, looking at transmission mechanisms so that you can identify the cause. And I think what we're arguing at the moment is you can't see at the moment whether a lot of the resultant actions are being driven by permanent changes in consumer behavior. And I think Faith referred to the fact that ultimately for the changes that are required to come about, you need some fairly significant changes in overall consumption with respect particularly to anything that generates emissions. And at the moment, most of those actions are being driven by policy direction. So you don't really know whether there's been a true change to the transmission mechanisms yet.
Okay, so you're almost citing or sort of saying that ESG is kind of about the longer term, it's about consumer intentions and behavior and permanent changes. Heike, can I come to you? And obviously at the World Bank, you're used to responding to crises and to human needs where they arise. I'm interested in what you think it means in terms of how development banks can respond to the problems the world is likely to face, but also in your interaction with the capital markets investors and whether what you have felt was interesting about the attitude of ESG investors to this whole pandemic.
Okay, so I mentioned at the beginning that the purpose of the World Bank or of IDA is a social purpose, and as we provide financing to our member countries for sustainable development, and as the pandemic was visible that this was a global problem. The World Bank responded quickly in working with countries in repurposing funds for what was first the sort of immediate human crisis, the health crisis. But as Andrew mentioned, and My-Linh and Faith, it's more of a it's not just a short-term crisis. It's a social crisis and will lead to or has led to an economic crisis. And the question really will be how this plays out. In terms of our interaction with investors, I mean, for some time, starting with the first green bond, which raised awareness for climate risks and sort of focused investors a lot on the E. we engaged with investors and tried to expand it and broaden it towards the overall mandate of the World Bank and sort of sustainability more broadly. We kept hearing that climate is a risk that's more visible in terms of the potential impacts, the more volatile weather patterns, and so forth. And the social aspect was more something in other countries. And I think that this crisis has, as My-Linh said, showed how absolutely interconnected we are, not just on climate as one planet, but on social issues as well. If somebody gets sick in one part of the world, it quickly travels and changes things in ways that we couldn't imagine. I mean, it's changed everything we do, the way we work, our consumer behavior, and whether that's medium term or long term. I think most people don't expect things to go back to exactly how they were. There's got to be change, whether it's triggered by government policy responses or otherwise. One other thing that I do want to mention is there's been a lot of discussion about sort of long-term effects. One thing that we learned in hearing from investors is climate change may be a long-term problem or something for long-term investors, but it affects pricing today. And I hope we get to this as part of the discussion, which is information, data, transparency. As investors have the information that they need to correctly price risks, that's how we'll start moving everything towards more sustainable activities. Because right now the models just aren't pricing in the risks. So it's not really a matter of when the risks occur, it's when perceptions change about the understanding of those risks. That's going to affect pricing.
Thank you. Well, we're certainly going to talk about metrics and standards and so on in a moment. But I just want to stay for a bit with the more, if you like, cultural or emotional side of it, and how we feel the conversation is changing and the consciousness among people involved in ESG. I mean, David, you obviously deal with it, talk to a lot of investors and so on. I mean, how have you noticed this segment of the investor community changing?
I mean, what we saw even before COVID was this kind of huge rise in focus, particularly driven by asset owners around ESG integration and climate change. And what's happened since COVID and during it, we've seen an acceleration in that. So, rather than kind of COVID suddenly diverting attention, it's just accelerated so many of the underlying trends. So this is coming from a number of different angles. On one hand, as you say, there's kind of a whole point in terms of affecting it in investor demand, where it's not just COVID, but you've also got interlinked things. We see things with kind of like Black Lives Matter, actually from COVID, with some of the poorest in society being hit hardest by this. There's this kind of, I think there is a rise in kind of social conscience, but also a desire to avoid the potential crises of the future. And as My-Linh was mentioning right at the start, the kind of interlink between a range of these things, where actually some of the predictions for the worst scenarios linked to climate is more pandemics. So these issues are highly interwoven. But what's been reported is, we see from the FT, says that 90% of wealth managers in their surveys are saying that believe that COVID-19 has actually meant increased ESG investments. Morningstar was finding during the early summer that actually, instead of net outflows in ESG funds, there were net inflows during the peak of the big sell-off. Incredible, really. I mean, and our experience for FTSE Russell is that what we're seeing is a lot of asset owners re-looking at their investment strategies. Clearly during what have been incredible changes in the marketplace, and that's led to a reassessment, wanting to make a range of changes to investment strategies to make to try and build in more resilience, but at the same time wanting to capture climate and other sustainability components as part of that change. I think there's been a lot of focus on changes in terms of ESG and climate, in particular integration into active management. We're also seeing this very much in terms of passive investment in terms of index funds changing and bringing in climate and often other sustainability themes within the design of these indexes. And COVID very much is accelerating that.
Thank you. I want to ask Clara, you obviously spent a lot of time thinking about what ESG means over the last umpteen years, right? And I'm interested in what you think about what other people are saying now. You know, do you think people are sort of waking up to what was obvious all along, or is this really a new element for humanity to deal with?
I want to pick up on some points. I'm going to respond to you, John, but also by picking up on some of the points made by other panelists, because I think the words, you know, exacerbated, accelerated, I could not agree with that more. Much of what I'm seeing was already happening. It's just sped up, and that's actually all for the good. I really like the comment on, you know, it's when the pricing changes because of risk perception rather than the risk actually materializing. And I couldn't agree more with that. And that is the link to transparency and data, as you said. I think that is what's basically making, I think, a lot of people say it is time for standards now, and not just voluntary standards that are perceived to be an alphabet soup, but rather clear standards that are driven by consultation and have regulatory support. And that was happening pre-COVID. So the European Commission came out in January with a commitment that there will be mandatory standards as of next year. And the progress toward that has not slowed down, even though you can imagine how many government officials are busy given COVID, but that continues at a pace. The project task force starts on Friday. So lots going on there. And that's kind of, I'm so pleased to see that continue. At the same time, the securities regulators globally, not just the European Commission, are taking an interest in the subject. IOSCO came out earlier this year, you know, with a statement that they were going to play a role in advancing ESG disclosure. And now we're looking at the IFRS issuing a consultation to look at its role in this area. Again, all of that has definitely been reinforced by COVID. There's two things I wanted to emphasize there that I think have not just sped up, but have really been cemented by what's happened with COVID in the standard setting area. And the first is that, exactly to Faith's point, I think that I certainly had assumed that climate would lead, and potentially even climate would be the only one to have kind of mandated backing in many jurisdictions around the world in the near term. And what I'm observing is a wider conversation about perhaps climate as a path breaker, but very much this needs to be about sustainability and the S of ESG, to Faith's point, really being accentuated. I want to add on to that observation that I do think it's really interesting how much products are becoming important in the ESG conversation. You know, we've been very used to screening out negative products. This is anecdotal, but certainly from my conversations with fund managers, what I'm hearing is that actually companies that are delivering essential services in a time of COVID really do look like they're going to outperform. And I think that's a pretty commonsensical argument. And I think we'll see more of looking at the products that deliver positive impact as being important in the ESG conversation. The final thing I want to say is that I'm privileged to facilitate a range of organizations in this area, and there will be an announcement later this week you should keep an eye out for. But I think what COVID has done has really also helped get the standard setters to recognize that, you know, in light of the regulatory interest and in light of this urgency, them coming together is going to be absolutely crucial. And so I wanted just to leave you with the thought that as we talk about how one might envisage sustainability standard setting in the same way as we have financial accounting standards, we've got to acknowledge that any system that results from this has got to be incredibly dynamic. You know, we all know how long it takes for financial accounting standards to be updated and to change, and there's really good reasons for that. But we've got to make sure that a sustainability standard setting system is designed so that it can be incredibly responsive to issues that overnight can become material for enterprise value creation, for example.
Yeah, I mean, I think that's really what we're talking about with this, isn't it? You know, theoretically, a pandemic was on everyone's radar, right? But was it actually, in a practical sense, something that anybody had prepared for? You know, several people have mentioned this issue of the S of ESG becoming more important, and certainly one would think so to listen to the public conversations. But I'm interested in, you know, should we be skeptical? You know, it's one thing for CEOs to publish letters on their website saying, you know, we care about Black Lives Matter, for example. But, you know, do their actions as a company, where they invest, where they put factories, you know, if they're a bank, how they extend credit, you know, is it actually backing that up? And so I'd like to ask, you know, if one of you would comment on this question of social equality and social justice within ESG. Is that really rising up the agenda, and how can we tell?
Maybe John.
I'm happy to. I was going to say, okay.
Yeah. Okay, let's go with Andrew first, and then Faith.
Okay. Well, I mean, I'll chip in with a couple of comments and then hand over to Faith. And I think, you know, at the end of last year, one of the sort of 5 key themes that we said investors should look out for this year was how inequality was starting to shape the policy agenda right around the globe. And really, I think our view is that this has definitely been exacerbated by COVID. And we kind of expect that companies' social license to operate is quite clearly under much more scrutiny now, and particularly entities that have received government support. And really not just the companies themselves, but there's also a lot more interest in supply chain because of supply disruption. And so I think the answer to your question is yes, this has triggered a lot more interest in the social aspects of it. And quite interestingly, the majority of those small handful of rating actions that we did take, which were due to ESG factors over the last quarter, for instance, were actually in the social categories. They were tending to be exacerbations and accelerations of trends around shift to online shopping and exposure to retail, for example. So I think yes, and I think that is a big and significant change. And perhaps one other addition, and maybe we'll come back to talking about this later. But when Clara was talking about when we were talking about structure, and we were talking about standard setting, I think it is quite interesting that the ability of the financial markets to rapidly develop the concept of a COVID bond really does demonstrate how the sustainable finance infrastructure can be leveraged to redirect capital towards shifting environmental and social objectives. Now, it may not be perfect, and clearly it takes a long time for standards to come in, but it is interesting how quickly that came about, and we can maybe talk about that later on.
Faith.
Hi, yeah, so I think if companies think that it's not going to matter, I think they're misjudging the situation. I think we had quite a massive societal waking up to recognising kind of where value lies within companies, and recognising the critical role of often people in the front line, even if it's people who stack literally supermarket shelves, and just how critical they are to our lives, and therefore where value is derived from a business. So in terms of sort of maintaining that momentum and pressure, if you like, on companies to ensure that is still part of their focus and it isn't just empty rhetoric, I think that does fall to the asset owner community. We are we represent the beneficiaries, and certainly the conversations I'm having with my fellow asset owners is this is very high on the agenda. They're wanting to amplify it. And they're wanting to amplify in terms of kind of the remuneration structures, really looking to things in the UK like the Corporate Governance Code and how the RemCos are going to actually then look at the remuneration strategies across the organisation.
Remuneration committees?
Remuneration committees, yeah. So with the new Corporate Governance Code, there was a new focus on the role of the remuneration chair, not just to think about executive remuneration, but to actually be mindful of the whole piece there, and I think that's very timely. The other element that we can use to identify whether companies are living up to the standards within the UK market, it's now a requirement for companies to produce their essentially their compliance to their director duties. So they actually have to make a statement on that. And I think next year's statement, when you think about in the UK corporate company law, the Section 172 requires the company to say how it's thought about its suppliers, its consumers, its impact on society, how it's treated its shareholders fairly, how it's all the key aspects that we're looking at. It's sort of distilled into one paragraph of what a director and what is the looking after and having a duty of care to those. And that statement next year, I think, will be very interesting, because it's going to be quite hard for companies to hide when they've got to be that transparent. So it comes back to this transparency around just how they're thinking about that. And that's just one tool we have in the UK market, but it's certainly that levels of transparency that I'm seeking elsewhere. And we don't just focus our energies on the companies, it's also the asset managers in which we employ. And one of the areas that we're doubling down on is in relation to diversity and inclusion. It has always been a theme. We do ask quite challenging questions of our asset managers about how inclusive they are and ensuring they don't sort of suffer from groupthink and some of the downsides from having a lack of diversity. But we have picked up more specifically on Talk About Black, which is a theme out of the diversity project, which is to sort of amplify and to try to make some more progressive steps of empowerment in that particular part of the community, which is really still massively underrepresented within the UK financial sector. So you'll be seeing more questions on our asset managers as well. And again, that's something that a whole group of asset owners are looking to take forward.
Thank you. My-Linh, I'd be interested to know, Faith obviously represents a very progressive asset owner, for want of a better word. You, I'm sure, deal with a wide variety of clients. Do you think what she's saying is representative of the wider movement among those who have capital?
Yeah, I think there's a regional bias as well to this that we've always had historically, I think, with ESG, but I think the disparity between the regions is narrowing, but we're still seeing that disparity. So I think we're seeing Europe particularly still leading ahead, Northern Europe particularly being very progressive in terms of some of these areas. We're seeing the US still catching up, but I think there is this general tide of being lifted up so that the baseline is moving up, certainly on there. But I think the challenge for us as managers is sort of having products that actually meet those requirements, given ESG encapsulates a whole wide range of different strategies and different approaches to this. So I think that's the challenge very practically, commercially for us, is like, where do we actually and that comes down to an understanding about which markets we have decided as a business is important to us, and then making sure that we then obviously deliver products which meet those markets. But I think, as the other speakers have mentioned before, this trend of ESG has been increasing before COVID. It's just really accelerated it, and like others have said on that side. But it's certainly something now that I think I'm so glad to say, because I think for a long time now, people have been asking me, is ESG mainstream yet? Is it niche? And I've always been, no, it's not mainstream yet. It's not mainstream yet. It's coming to there. And I really do genuinely feel this year it has sort of reached that stage where I feel that it really has moved from a nice to have to a need to have, whereas I couldn't really sort of talk about that, but I think I've got enough data points across a range of regions on that. I just wanted to come back to your question about social. I know a lot of, and I would certainly confirm that the trend that social issues have been reinforced, but I would have probably pick up another point that for us, we've actually gone back to G as well, but I think what's the difference is the type of G that we've looked at. So maybe
governance.
Yes.
Yeah.
So and what I'd mean by that is that before there's a lot of talk about pay, a lot of talk about gender, and that I think what this crisis has highlighted, and we've gone back and doubled down on, is actually understanding about the board and the quality of the board in the context of the quality of their and their sort of skill at and their preparedness. So actually really drilling down a bit more on their risk management and their crisis management strategy. Because this is the test for it. Did they actually have one at all? And to what extent was it so narrow that it actually wasn't very effective at all? To what extent was that company very forward thinking and that they were able to be very adaptive and resilient? So I think for us, the G has come into it in that it's understanding about their crisis management, but it's also understanding about to what extent have they made sure that the business is resilient to future changes. Because I think whilst Andrew is right in that some of these may be temporary and maybe not so sort of permanent as we think, I think the reality is there will be a new normal. I don't think we will ever go back to completely what we had before, but whether it's more in the middle than where it is at the extremities, on there I accept that point. But I think it's really more and more reinforcing the importance of companies and board being resilient and adaptive, and I think that's where the ESG mindset and thinking is really helpful on that sort of side. So I guess that's where I just bring in that little bit, and there it's really refocused for us sort of issues about the quality of the board, but emphasize different areas ultimately, and understanding what is their long-term strategy.
It's an interesting comment, because we've had a number of issuers commenting to us that their investors really have been looking a lot more at how they cope with managing ESG risks that are structurally evolving. So precisely what you're saying, My-Linh, and that for some of them, they found that quite surprising, that all of a sudden people are saying, well, it's not actually whether you have a policy in place, it's actually how adaptable is that policy, and does it in practice really work? Because if it doesn't, and interestingly, we've had a number of instances where we've had governance issues with entities. That's probably, out of the ESG, that's been the biggest factor over the last 2 quarters. And generally where those have been problems have been where people have thought they had a policy that would work, but actually when it came to actioning it, they discovered they maybe didn't have the capability to action it, or they were too slow.
Yeah, I think there's such an opportunity, isn't there, with this as well, is that we've seen such a transformation, is that maybe the strategies they've come up with have been predicated on things carrying on the way it is, and that's what the world, and that's how you adapt. But because and it's all overhauled, and it's like, actually you can run your business in a very different way. You know, how do you do that? So I think there's such an opportunity with all of this. So maybe that's why investors are asking all of this, that it's not just through a risk lens, but it's actually understanding that the company is able to capitalize off the opportunities that this represents, and that actually it could be a good permanent change rather than sort of viewing it very negatively.
So I just want
a very interesting proxy season next year.
Sorry, Faith, I didn't hear that.
It's going to be a very interesting proxy season next year, because we'll have a lot of evidence with which to then challenge boards.
Yeah. Now there are 2 people who wanted to speak, so I'm just going to go to David first, and then Heike.
I was just going to pick up on that social themes, of firstly on issuers and then on the investor side. So on the issuer side, we certainly see actually this rise of use of COVID bonds as a very effective way for issuers to directly raise capital using sustainability platforms. So we allow on our sustainable bonds marketplace COVID bonds within the social segments. We also waived listing fees as well for those. But then on the investor side, I mentioned earlier that we've seen this huge rise in asset owners wanting to incorporate climate into their passive investment strategies. What we've started to see is on the social side as well. So just pre-COVID, we had the Dutch pension fund Detail Handle, who was the first asset owner to bring sustainable development goals into their core passive portfolio. And so we designed an index that overweighted companies that were better positioned on a range of SDGs, including both social and environmental SDGs. And certainly in the discussions we're having at the moment, it's pointing towards much more of that in the future. So yes, huge focus on climate not going away. In fact, desire for more sophisticated approaches. But a lot of focus on social too now.
Yeah, thanks, David. Now, Heike, I know you want to say something, but I'm going to also give you a question, which is about what responsible investing is really for and should do. And it's so perhaps after you could address that too. What I mean is, one way of doing responsible investing and ESG is to think about, where are there risks that are ESG risks, and how do we avoid them, right? Let's go for investments that don't have these risks. But then when something like a pandemic happens, does that arguably mean you are going to withdraw capital from the places and the communities that are hardest hit, and actually is the opposite of a positive impact strategy?
Okay, so what I wanted to pick up on first was My-Linh using the word opportunity. And I think that's something that we've definitely picked up on, is this investor interest in ESG. And we haven't spoken about it as much on the panel yet, but also interest in impact. So investors' interest in making a positive difference with their investments. So the whole financial characteristics have to be there in terms of credit risk, liquidity, and the product, the terms, but they're looking to make a positive impact. And David mentioned COVID bonds. So in the case of the World Bank, we're trying to support this holistic approach, which is for investors to look at the issuer overall and be completely transparent with what we do and how we do it. And again, because of the purpose of the World Bank, because we exist for impact, we measure that in every project that we finance. So we have a Sustainable Development Bond Impact Report that covers our entire balance sheet. But we are taking this interest in ESG, and especially in the Sustainable Development Goals, as an opportunity to raise awareness for specific things like health and nutrition or education. So we see a lot of interest from investors to understand how countries are addressing COVID through remote learning and digital education. So the importance of technology, things like that. So we can have these types of conversations with investors that we didn't before. They just weren't as interested in those themes. And this comes to your question about responsible investing. I mean, most of what we've discussed has been about how investors look for value for their portfolios, as opposed to looking for value for society. And if both of them match up, that's fine. But the whole way the financial system works, and that's why I was mentioning this about pricing risks, the whole way it works is you have to assess the financial risks or opportunities for your portfolio. And if it helps channel funds towards sustainable investing, that's good. And you can communicate to your stakeholders. We say do well financially and do good for society. But it all comes down to this, to the pricing of risks, because investors aren't, they're not, in the business of philanthropy. They have to show the bottom line, and they have to compare their risks against other risks. And if they can convince, or if they can show that integrating ESG risks makes a positive difference to financial aspects, that's good, but they have to be able to show that. So this conflict, or what does responsible investing mean? It depends how the investor is defining it. And I do think that, harmonization of how companies report, harmonization of impact reporting metrics, that will help to bring transparency and help investors compare. But there's a lot of work that needs to be done in analysis to get there. So I think ultimately the goal is sort of a pricing of assets, of investments, and all the things that we're doing now with labeled bonds, with indices, with all that is so hopefully getting us there.
Clara.
I just want to pick up on that as a final note and say that the reason why we've chosen to focus on the standards piece rather than the rest of the ecosystem of data, which is equally important, is because I think even you've heard through this conversation that the nuances of individual investors' analysis or indeed individual rating agencies can be quite significant, and different people will judge things, whether they are a risk or an opportunity, quite differently, and that's natural. What we need is the standards piece so that if one wants to look under the hood of the analysis, as it were, you've got a comparable data set underneath. And I think that the point on those who are actually coming to the investment conversation now with a values-driven lens, whether it's coming to wealth managers or large asset owners whose pensioners might say that we want to see this, I think that is putting additional pressure on the measurement conversation, because interestingly, and I will end on this, people talk about positive and negative impact as though it's a given. One knows what's positive and one knows what's negative. In fact, the only way you can know is if you have credible data that you can then compare to a social or ecological threshold. Local living wage is an example of a social threshold. We have science-based targets for carbon. That, I think, is making for a more sophisticated measurement conversation, and I anticipate that continuing.
So I'm going to go to David in a sec, but just to be absolutely clear, what you're talking about by standards, you're talking about specific grades, effectively, or scales that any company can be measured against for different aspects of its performance.
So the easy way to think about it is that where it is possible to create a disclosure solution for a given topic, whether under biodiversity, there's various topics, employment, health and safety, etc. For each topic, there then needs to be consultation on the right disclosure requirements, what the market would often call metrics. And that's what I think of as the basic disclosure standards that we need in place today, that I do think can be agreed for a whole range of topics. And in fact, obviously, a lot of agreement has already been reached. The point is on harmonization of that so that we get to something that can be backed by regulation, ideally globally, John.
Okay, thank you, Clara. David?
Yes, can I just come in on that? I think we need to have global coordination, global action to drive change. The biggest emergency, which acts as a multiplier in so many ways, is climate change. Here is an area where we've got some clear global framework through TCFD, the Task Force on Climate-Related Financial Disclosure. We've got some fantastic now investor-related initiatives. So Faith hasn't mentioned it, but she also co-chairs TPI, the Transition Pathway Initiative, very powerful initiative at linking academics, asset owners, and asset owner-driven initiative. It also feeds into CA 100+, the biggest global collaborative investor engagement initiative ever. But also exchanges have got a key role to play here as well. And I wanted to make that point, that exchanges can play a really important role in helping drive better quality data. For us, it has this double effect. We're a consumer of that information through the FTSE Russell side, and asset owners and our investors need consistent data. We're also a key influencer working with issuers and supporting issuers navigate disclosure. So here we've been trying, we wrote a letter with Mark Carney and our group CEO to exchanges globally to join us, try and work together to drive all exchanges to develop guidance for their own markets on climate reporting based on TCFD. We think it's very powerful for exchanges to adopt and drive this. And so hopefully by early next year, we'll have model guidance which each exchange can then push in their own markets to help drive consistency here. But we all need to be working together and coming together. We've got very little time to now get the world on the right trajectory on climate change.
Thank you, David. I'm going to say now that we're going to move into the live Q&A. So there's an enormous amount more to talk about. Obviously, we've chosen an enormous topic to start with, and we've taken some very interesting bites at it. So if the audience would like to click on the links in their hub screens to the live Q&A Zoom call, which is going to begin now, please do that and join us for the end of the discussion, where you will have the opportunity to put further questions through the interface in the Q&A function, or you can raise your hand and ask a question, directly, and be shown and ask with your voice. So we'll switch to that now. Thank you for joining us for the question and answer session at the end of this fascinating discussion about COVID and ESG and the implications each has for the other. So we do have some questions from the audience, which I'm going to ask our panel, see if they can answer. So to begin with, there's a question about the way the world has reacted to the pandemic. And the question is saying, I agree with My-Linh that the pandemic shows the world can act quickly and decisively against a new threat. But is there a danger that once we deal with that we relapse into complacency and don't deal with other threats that are not so obvious, such as climate change, social inequality, and so on? Who'd like to take that?
So maybe I can start with that. Actually, I think it would be nice if there were a risk of complacency, but I think unfortunately there's so many things happening faster and faster that we see, that we're all aware of, that affect us. Just as an example, the wildfires on the west coast of the US. Here on the east coast, we notice haze, so we see it here even because of weather patterns, or there's more and more reports about more floods. So I'm sorry to say that I think that the problems are so visible that there's a little risk to go back in complacency. But I'm interested what other things think as well.
I think it's interesting because I think there is also a flip side to it. I think the question mentions a recession, depression following on from the pandemic, and that people get complacent under those circumstances. I would agree with Heike. I don't think there's too much risk of complacency, but the problem with that type of economic circumstance is it does reduce capacity for action, not only for individual entities, but also for governments, because funding has been diverted elsewhere. And so there is a real risk that as you enter that phase, it's not an issue of complacency, but of capacity to be able to continue with some of the actions that were being taken and continue to accelerate actions. So there is a real risk that action gets postponed, and we've seen some of that already in cancellation of renewable projects, postponement of target setting, And it will be very interesting to see how that plays out.
That's a good point. Thank you, Andrew.
I think it's incumbent on all of us not to make that happen.
Yeah. Well, you mentioned government funding and governments having enough money to do things. I mean, obviously, where governments get their money is from taxation. And this is an interesting issue for ESG investors, because obviously, there's a clear social benefit to companies paying their taxes properly and not using complicated strategies to avoid it. On the other hand, investors, particularly shareholders, generally quite like it if companies maximize profit and don't go paying away a lot of money in tax. So, is thinking changing on that question?
I think tax is actually one of our engagement priorities at Brunel. So it's one of the themes. It isn't one of the, I suppose, one of the more sexy topics that gets talked about all the time. It is sometimes a bit dry, but we do, and we have actually got on our website, if anyone's interested, we've actually published a tax position statement which kind of highlights our thoughts on this, which is we do see tax as an essential component of a healthy and thriving society, and it's how we kind of the companies. It's not undesirable. It's about appropriateness, I think, in terms of making sure that you're paying the appropriate amount of taxes into the economies for where you're generating those revenues and returns. So I think our position on it is more around transparency and pushing that element, and that's where we sort of have engaged and asked for support. And I think there's been some interesting linking then to the actual pandemic and some of the changes we've seen there. We've had countries come out. So Denmark has said that you can't have a bailout if you're then using tax havens as part of your strategy. So if you're a corporate, you can't have a bailout. And then we've had other countries like Canada link it to climate change and say that if you want that your tax, in terms of that's more to bailouts, but to TCFD transparency, but recognizing you can't have your cake and eat. You can't just take from one side of the economy and have the support and then not providing the transparency on either your tax or your climate or other essential components to the economy, and making sure that it's a fair treatment and that everybody needs to step up and show that they're doing their bit.
Thank you, Faith. Yeah.
Do as well. I think investor perspectives on tax has shifted over the last 5 or so years. About 6 or 7 years ago, some charities and NGOs came to see us and asked us if we would incorporate tax responsibility into our ESG methodology. And at the time, we thought this was an ethical issue, not really an investment issue. Spoke to a number of institutional investor clients who said, actually, no, this is something we're kind of interested in. Actually, where you have a company which has got quite complex tax affairs, it may look very profitable, but actually, as some of those things get closed, all of a sudden, it's not so profitable and you're holding it. And so we, in the end, developed tax transparency criteria, covering things like, is the tax policy being signed off by the board? Is it publicly available? Is there tax reporting country by country? At the time, there wasn't a GRI set of criteria on that. Just in January at the exchange, we hosted the launch of the GRI standards on tax. So we've now also got kind of a clear global framework as well for us to all use there. So this is an area which has evolved, I think, and now is increasingly being regarded as a very relevant investment issue.
Thank you, David. I'd like to ask you a question about derivatives. Now, it's not something that is very often talked about in ESG circles, but there are ESG derivatives, and it's something that the investment banks are quite excited about. They are sort of producing various different products. And the questioner asks whether this is, just banks sort of trying to come up with clever new products, or is there actually a value to this? And he says that there's research that shows derivatives can help direct investors towards ESG, investing in ESG causes. So anyone have any thoughts on that?
I can give some quick thoughts in terms of it. So what we've seen has been obviously the growth of ESG integration into active management. We've seen the growth of ESG integration into passive management and into a lot of index funds. There's quite a plethora of different approaches there. A lot of different investors have got different priorities, and therefore there's a variety of indexes. But what's missing is that there hasn't been so much in terms of derivative options. So where you've got And we've had a few clients who've said, well, actually, they would like to see versions of FTSE All World, other FTSE indexes, which are ESG versions which are which can be used for derivatives and futures. So this is something which we'll see more on. It's a slight challenge in that, because each investor is taking a slightly different approach, you've got some questions there about which particular ESG indexes are going to be most valuable to support derivatives. Thanks,
David. I want to now come on to what is perhaps the biggest question to come out, or certainly has been asked by several people in different ways. And so, for example, we had one member of the audience has asked, how do the speakers feel about shared value integrative metrics? And another has said, well, what do we do about harmonizing ESG metrics? And he points out that with credit ratings, Moody's, Fitch, and S&P generally have a sort of reasonable consensus. Andrew, I'm not suggesting that there's groupthink or anything, but there's a correlation between credit ratings, whereas in the ESG rating space, very often the answers are quite radically different. But also to ask the panel to think about the question of whether such harmonization is actually desirable, or is it actually a good thing that people take very different views on ESG questions. And perhaps I should have said at the beginning that Olivia Prentice has kindly joined us to replace Clara Barby, who was unable to be here for the Q&A. So Olivia from the Impact Management Project, perhaps do you want to take that one first?
Thank you so much, John. And I guess it's probably no surprise to all of you that as the IMP, we are a fan of harmonization. Our whole initiative was set up to try and coalesce and make it easier, right, for practitioners to really understand what information do I need, how do I get it, and what do I do once I have that information. And actually, I'm really pleased to be able to share with you all today that just last Friday, a joint statement of intent was published by CDP, CDSB, IRC, GRI and SASB. Some of those acronyms I hope are familiar to all of you, as they are the 5 leading players who really provide the data standards and frameworks for corporate reporting. In case you haven't seen it, this paper shares how these organizations are coalescing around a shared vision of the elements required for a comprehensive corporate reporting system. What that means is that these organizations are working together to figure out how the pieces fit together. I think there's been a lot of confusion in the market for a long time. Is it GRI or SASB? Is the domicile of these standard setters relevant? And this paper really presents a system collectively that connects both financial and sustainability disclosure via an integrated reporting framework. So hopefully this is really exciting progress towards harmonization, at least of that piece. It doesn't, of course, recognize the ESG ratings. And I think it's an interesting conversation to say, well, once the voluntary standards move, what does that mean for the raters that sit behind a paywall? What does this obviously mean for regulators, both in the EU, IFRS and elsewhere? But it's really promising progress. And of course, I should mention, given Sir Ronnie's speech earlier, that of course that's one piece of a wider puzzle of standard setters who are coming together to figure out, okay, well, if we have that heart of data standards and reporting frameworks that can be agreed upon globally, can we also then be a little bit clear about what are the widely agreed valuation standards, what are the widely agreed principles of practice for different organizations, for investors, for companies, that can all therefore lynch off that corporate reporting system. And so I wanted to just recognize the rest of the structured network, the now 16 organizations who are working together to try and map that all out, which will hopefully be also published next year.
I can add to that because Olivia referenced the speech that we heard earlier. So I thought it was very interesting that he was saying that we need to do with impact transparency what we've done with financial transparency. And I think an important piece is this harmonization of metrics so that you can compare the raw data. But we should look at not just sort of negative impacts, but also positive impacts. And the positive impacts is, I think, something that people don't pay enough attention to. As a development bank, it's what we focus on a lot, is the positive impact of our projects. And as part of the green bond principles and social bond principles that are coordinated by ICMA, there are working groups that on harmonization of these metrics that we helped start, where issuers and others get together and agree on what metrics they will be reporting on for their green bond or social bond or sustainable bond reporting. So I think this harmonization of the data is helpful rather than harmonization of ratings or of the analysis piece.
Okay, thank you. I'd like to go to My-Linh now.
Thank you. Maybe just to add to some of those, we're talking at harmonization at different levels of data, of ESG ratings, of reporting disclosure framework, and there's clearly a need to be able to benchmark. And I think to your question, I think harmonization is desirable, but only to a point, because I think we need to recognize that there's different use cases, there's different audiences for some of which this data's for. So actually, it's actually quite legitimate and valid that there may not be a perfect correlation between some of the ESG ratings because they're measuring for different things. So I think it's important to be transparent on there. So for example, for ourselves as an investors, we're primarily focused on investment materiality, but for another stakeholder group, they're interested in how these issues are being managed from a sustainability materiality point of view. And the two may overlap, but not in all cases, depending on timeframes, depending on different ways that you're having investment exposure. So I guess my point here is that I think harmonization is definitely needed, and it's being now we've gone down the voluntary route, and now it's being pushed through the mandatory route. But I would just urge caution in that I think we don't want to generalize too much or consolidate and aggregate it too much when actually we've got some very different and legitimate use cases for them, and we shouldn't lose that.
This is, I think, a very good point, and this is really the question I tried to ask Sir Ronald Cohen this morning. As Olivia mentioned his talk, and I think that it is extremely interesting, the idea of moving to impact accounting, and what he and the people at Harvard Business School that he's working with are working on is the idea that you can actually through a sort of official process, rather like accounting, put a monetary value on the negative and the positive impacts of organizations. So I'm interested in whether the panel think that is actually feasible and attractive idea. Andrew?
I mean, I think the original question mentioned the rating agency approach versus the ESG ratings approach. And I very much agree with the other panelists so far that harmonization of standards and disclosure of data is very important, but you don't actually need harmonization of methodologies to analyze that data. And in fact, variety, as My-Linh was saying, can be very useful. I mean, really, the same applies, I think, when it comes to trying to assess impact. Again, if you can have a harmonized data set, because effectively where we want to move towards is that there are clear standards around disclosure of information for entities. That then means that they can implement internal controls that ensure their disclosures meet those standards. And ultimately where you want to get to is an ability for those internal controls and the external disclosures to have some assurance around them, so some form of external auditing. And if you can get to that stage, whether it's for the ESG ratings or for that matter for the impact assessment, be it positive or negative, then you start to have clear transparency, materiality and comparability of information. And that really is the key. And that's the big difference between where you see credit ratings and ESG ratings at the moment. Most of the data that underlies credit ratings has a very high level of assurance and standardization around it through the accounting regulations. But even there, if you think about that, they always come with notes and there's interpretation. So it's never the question that you're completely rigid. There is always some room for interpretation. But I think, as Olivia said right at the beginning, we're lacking that level of standardization and we need to move towards that. And it's fantastic to see some of those initiatives being announced last week.
Thank you. Faith, where do you stand on the harmonization versus diversity, if you like, of ESG information and frameworks?
Thank you, John. Yeah, I think very much on the same lines as My-Linh, really. So we use SASB in that sort of base case. What I consider SASB to be is like the basic, the minimum reporting requirements that we should be looking for corporates to do. Look for GRI to reach the sort of wider stakeholder base and be able to engage with your communities and other stakeholders who are interested in sort of some broader metrics. And then we need to move beyond those then to impact metrics to look at the real world impacts, and there are stakeholders and investors who are interested in elements of that. So absolutely agree. It's about a framework as to how they fit together. I think there's been confusion over the years between things like SASB versus GRI. In fact, they do actually do very different things. Yes, there is overlap, but there is space for both of them. So it's not about crunching everything together and getting one massive organisation doing all this. As My-Linh says, it's about understanding what the role is of different frameworks, how they all piece and fit together, where they do, and then for them not all, for them where there are overlaps, not to provide conflicting methodologies in terms of calculations. I think leading on from the points that Andrew's made, I want to flag that we've been advocating for a very long time around quality standards. So I think there just needs to be higher, so where there's an ISO standard around environmental data generation, so that there is some minimal thresholds because investors and stakeholders make decisions on those, and we just need to have a sort of a higher quality. In terms of the impact accounting, my career actually before coming into the world of responsible investment was actually in environmental accounting. So it came from those same roots, which is around kind of how do you place a value or how do you get companies to take account of the environment. And this is in the period before anybody was really talking about climate change, or was thinking about things like landfill costs and things like that, and overheads and how they should be properly attributed. So I think there's a lot of value in that. That said, I am still an advocate, I would say, in terms of real world metrics related to the impact and the outcome you're after, rather than trying to make it into a pound sign. Pound sign can help in some instances, but we need to actually measure things in terms of the impact and outcome we're actually seeking. So if that's jobs created, if it's to do with retention numbers, if it's to do with gender pay gap, if it's to do with diversity, then it needs to be in the metric for which the outcome is designed, rather than trying to distill that to a financial value. Because I think sometimes you can lose the essence of what you're actually after if you do that too much or without consideration of the more important metric.
Thank you. Well, time is running on. I want to give David a last chance because he hasn't had a chance to answer this question. But then I think we'll end after that. David?
Okay, well, thank you. I mean, I think obviously there's a lot of diversity in sustainability and ESG assessments of companies. I think some of that can come from different, because the underlying data is not reported, and as the other panelists have all been discussing, that creates big problems because it means that we and others have to then try and find ways to estimate missing data, or you score a company down for not disclosing it. But that creates a big variation in assessments simply because the underlying data is not there. So all of these initiatives, be them kind of market-based ones or regulatory ones, if that can improve global consistency of the underlying raw data, that's very helpful for the whole marketplace. I think, as everyone said, what's also helpful is actually to have a diversity of approaches in terms of the broader assessment, to be able to get different kinds of insights, as long as you can understand why these different assessments are coming up with different answers. I think one area where we've seen really good progress has been on climate, and that's because we've got a clear global framework through TCFD, which is giving us a good basis for that. And there are emerging kind of frameworks as well, not just the underlying raw piece, things like CA100 Plus and TPI, which gives a common basis for investor action. So I think, hopefully we've seen that on climate. I think we can see similar things in other areas as well. And certainly with the main standard bodies coming together and working more closely, that can help, and it can be accelerated through initiatives like IOSCO getting involved and trying to drive the regulatory responses as regulators get involved, that they work together. We don't see regional divergence here, but actually regional coming together through a global framework.
Thank you, David. Well, with that, I'd like to thank this excellent panel. I mean, for a superb range of thoughts, and there's so much there for each of us, I think, to take away and, think carefully about ourselves. And it's clear from this discussion that really we are at quite an early stage in puzzling out all these issues, which is very exciting. But one's aware that it needs to be got on with. There isn't a lot of time, as Heike mentioned, the haze over Washington. We need to crack on with these questions. So just to sum up the whole day, really, I think it's been a fantastic day, and I'm very grateful to all our speakers and our audience for joining us. If you'd like to watch any of it again, it is available online for the next 30 days. You can tell your friends about it as well. I'm sure they'd benefit too. But I just, just to pick out a few points, I mean, I thought Sir Ronald Cohen's talk was fascinating. This very challenging, ambitious idea of impact accounting, which he believes is only 2 years away from being not only realizable, but actually mandatable. And a very interesting comparison with 1933 and the invention of proper standardized financial accounting. And then, we had a superb discussion about the green recovery. And I think what came out of that very clearly was the sense that this really is a new moment. We asked the question, essentially, are we at a tipping point? Are we, does COVID change things? It really does. And it's clear that there's a greater sense of urgency in society. Several of the speakers on this panel mentioned that as well. The conversations we're having at this conference today are different from the ones we've had in previous years. It's exciting. It's also daunting. And, the one encouraging thing is that there are so many people now exercising their brains on the problems in such an active way. And we've lucky enough to have had many of them here sharing their thoughts with our audience today. So thank you very much. Please join us tomorrow morning. Tomorrow's session starts early to take in Asia, but please join us for that. And thank you for coming to our conference.